Hello everyone. In my previous videos, we have discussed about the important formulas like ROCE, ROA, return on equity and all. We have discussed in detail what are those formulas, what are the usage, how we can interpret and analyze those, what are the limitations. We have seen all that. In this video, we'll quickly have a summarized form of those, right? We'll see what is ROE, what is ROA, what is ROCE, and we'll see what are the difference between these formulas or the ratios, and in which situation we should use what. So it's a very summary video to make you understand about all these three, their formulas and their effective utilization. If you want a detailed understanding, you can go through my previous videos. Okay, so this is a very summary and quick video. Yeah, so let's begin. So let's understand. So here I have written some of the basic basis on which we will see what are the differentiating things between all these three ratios. Yeah, so let's start. First is formula. So let's understand what's the formula. ROC. ROC is return on capital employed. So its formula is EBIT upon capital employed. EBIT upon capital employed. Capital employed means equity plus debt. Multiply by 100 because all these are presented in form of percentage. Okay. EBIT upon capital employed. Like we can take the average capital employed also. This is just basic formula I am writing. If you need detailed understanding, please go through my previous videos about the ROC in detail. But here I am just writing very high level summary thing. Yeah, this is the formula. ROA means ROA formula is net income divided by average total asset. Multiply by 100. Net income means PAT. PAT divided by average total asset multiplied by 100. That's our formula for ROA. ROE, return on equity, means ROA means return on asset. ROE means return on equity. So return on equity formula is PAT minus preference dividend divided by equity shareholders fund. Equity shareholder fund, in which we include we include the equity share capital plus retained earning and all. So multiply by 100. So this is the formula for all these three. Yeah, so now let's understand what's the purpose. What's the purpose of these formula? What do they show us? Okay, so ROCE is basically its profit and the capital employed, right? So basically it shows how much profit company is earning by using its long-term funds. How much profit company is earning by using its long-term fund. This is something this ROC shows us. Okay, how much profit company is earning by utilizing long-term fund. This capital employed is nothing but the long-term fund. Now what does ROA show us? ROA shows us how much profit. Here we are talking about the profit, net profit. Okay, and here we are talking about the average assets. So how much profit company is earning by utilizing this asset. By utilizing the asset, how much profit company is earning. So here profit and asset, how much profit company is earning by utilizing the asset. And ROE is basically profit for the shareholder. How much profit company is earning for equity shareholders. How much profit company is earning for the equity shareholder. That's what this formula says, or that's what the ROE tells us. Yeah, that's the purpose. Now what's the key usage? When do we use it? Okay, or what are the key metrics basically, or what are the key understanding we can draw from this? Okay, so here we are talking about utilization of capital employed. So basically it shows how effectively company is utilizing, how efficiently company is utilizing. Efficient utilization of capital, how efficiently company is utilizing its capital to generate the profit. How efficiently company is utilizing capital to generate the profit. So basically it shows about the capital efficiency or effective utilization of capital. One thing is show. Other thing, it shows about the overall operating efficiency. It also shows overall operating efficiency, because we talk about EBIT here. What is EBIT? EBIT is earning before interest and tax. EBIT is also called as operating profit. There is a slight difference between that, but more or less it is same, right? So it talks about the operating profit. So if the company is earning good EBIT, it means their operating efficiency is also good. So it shows two things, basically effective utilization of capital, and it also talk about the, or also you can interpret the operational efficiency of the company using the ROCE formula. Whereas ROA, it talks about the profit and assets, right? So how much profit company is earning, utilization of asset. So basically it also tells us about the asset efficiency, or you can say another term, effective utilization of asset. Effective utilization of asset. So when you compare this formula with the peers or industry, right, so then you would know whether company is able to utilize its asset effectively or not. If company is earning good profit on its asset, through its asset, so it means their asset efficiency is good. Asset efficiency is good, it means they are able to effectively utilize the asset. So that's what this shows. Yeah. Return on equity, again, basically it's a profitability measure. Okay, it measures the profitability for the shareholders. It measures the profitability for the shareholders. Yeah. So that's about the ROE. Now debt consideration, whether in this analysis debt is considered, in this ratio debt is considered or not. In this it's very evident, we can see in the formula, right? In the capital employed we considered the debt, so debt is considered. Here in this we consider the total asset. So basically what happens, like what is asset? The total asset, like when you see the balance sheet, right, asset is basically, asset is equal to equity plus liability, right? Asset side of the balance sheet is equal to equity and liability, right? So asset means equity plus debt, both, right? So when you are considering the asset, it means indirectly you are considering the debt also, right? So here also debt is considered indirectly, not directly you can see, but indirectly it's there. So debt is considered here, but here it's all about the equity shareholder, so debt is not considered here. That's another difference, right? Now what is ideal for, like when to utilize this, when to utilize this, when to utilize this. Okay, so ROC is actually very commonly used metrics or commonly used ratio in all the industry, all the companies. This can be used. So this can be used anywhere, all the places, right? Especially when you have like debt and equity both in your capital structure, you can use it, but it can be used anywhere. So all the cases it is used or it can be used. ROA is generally used for asset heavy industries, because it talks about the the profitability against asset. Okay, it talks about profitability against asset. So wherever we have the asset heavy industries, right, with the manufacturing and all, where the lot of fixed assets are there, so that's where the importance of ROA increase, because they really need to know how their assets are performing, whether they are able to generate the profit or no. And ROE is mainly used for the investors point of view, for the shareholders point of view, or the investors point of view. If you are going to invest in a company, then you would like to see how much return as a equity shareholder you are going to get. Even the finance manager or CFO, when they analyze it considering from the shareholders point of view. So it is basically used for the shareholders point of view or the investors point of view, right? So that's the difference between its utilization, or when it is ideal, for who it is ideal, right? So that's basically the summary about all these three formulas. What are the key differences between those and when to utilize what. So I hope this video, like it's a summary video, and if you want more detail, you can go through my previous video. For each of this formula I have discussed in detail and explained, but this is a summary video to quickly help you understand what are these, what are the differences, and how you can effectively utilize it. So guys, if you like my video, then I request you to please like and subscribe my channel, and please provide your comment whether you like, or whether you want any improvement, or whether you would like me to explain any topic, right, on the financial analysis or financial management. Please write it in the comments, and I'll be happy to take up those topics. So thanks for watching this video. See you in the next video. Bye bye.